Hey guys, welcome. I'm going to give everybody a moment to join before we get started. I apologize for being a couple of minutes late. I've been doing a lot of heavy lifting on my PC today, and it seems like it's put some strain on it. So I think I need to upgrade some pieces because my PC kept freezing before trying to run this stream. So I apologize for being a couple of minutes late. But like I say, we're going to give people 30 seconds or so, and then we'll jump straight into the session. Could somebody in Discord please confirm in the chat whether you can hear me and see my screen? It would be really, really appreciative. See a couple of familiar faces that I haven't seen in a while. FX Pitfinder, Kaizen, Wazmataz, welcome dudes. Hope you're all good. Awesome. Thank you, Pitfinder. I appreciate that. So guys, welcome to today's session. And this is a more complex session that we run on a weekly basis where we dive into the intricacies of a Darwin so we can help you understand exactly what's going on behind the scenes when you're trading at Darwinex Zero. Kaizen, good mate, we can hear you all. Fantastic. Thank you for confirming. Hope you are well, dude. If you're new around here, my name is Kieran and I'm head of UK growth and business development for Darwinex. And if you don't know about Darwinex, we are a regulated broker, asset manager, and now hedge fund also. We're regulated in 3 different jurisdictions by the FCA in the UK, by the CNMB in Spain, and also by the FSA in the Seychelles. We have over $100 million of total AUM invested. That's from third-party capital, thinking family offices, hedge funds, investment banks, high net worth clients, retail investors. And then we also have over 10,000 active strategies on both Darwinex and Darwinex Zero. Our job as a company is to bring capital to traders who deserve to scale their systems. So traders who are consistently profitable over an extended period of time. Our job to you and our pledge to you is to help you attract more capital by proving your track record by trading with Darwinex or Darwinex Zero. Now we're going to get a little bit technical. So there's going to be words and phrases that are very Darwinex-y. So if at any point I'm going a little bit too fast or there's something that you don't understand, please feel free to put in the chat box, whichever platform that you're watching this on. Please feel free to ask questions and I will try and go through them as we're going through the session. And if there's any at the end, I'll make sure to set some time so I can finish answering all of your guys' questions. But to begin with, what is the point of a Darwin? So I actually want to take this back. What is a Darwin? Okay, so a Darwin is an indexed representation of your trading strategy. So what we do with our traders is we take all of your trades and your strategy, we index it, basically turning it into an investable asset, and then we risk adjust it, which we'll get onto in a moment. And I'll talk to you a little bit about the levels that we risk adjust it to and why we do that. Now that you know what a Darwin is, it's very simple. That's exactly what it is. Index version of your strategy that's risk adjusted. What is the point of having this? Okay. So number one, it's risk adjusted. Not everybody sees this as a positive because people think that it's reducing somebody's performance when in actual case it's not. We're using a barometer of exposure to mirror your exposure as a trader, which I'm going to get into a little bit more detail. So please just bear with me as we go through this. But the great thing about having a risk-adjusted view of your trading strategy is that it allows you to understand a little bit more or a little bit deeper into what you're actually doing as a trader and how much exposure you're taking to generate a return. Most traders don't know this, especially when they come from the funding company space, because you don't really understand the real exposure that's at stake every time you press that button. Second point is you come under Darwinex's regulatory compliance. Now, depending on where you are in the world, it is going to be, different levels of difficulty to manage investor capital. But generally, you're going to have to be regulated to even touch an investor capital, which is going to cost you a lot of money. It's going to cost you a lot of energy and effort. And after all of the energy and effort and money that you put away to the regulators, they still might say no, or they still might strip your licensing. Now, in the UK, for example, I cannot physically hold or manage capital on behalf of an investor unless I am specifically regulated to do so. Going back to what I said at the beginning of the presentation, is Darwinex is an approved and licensed asset manager, which means we can under the FCA's regulatory guidance, we can take investor capital and we can deploy it into investable assets like Darwin's. Without that, it's kind of the cowboy era, right? You're not allowed to manage investor capital without this sort of infrastructure. Rather than going and doing it yourself, you can trade through Darwinex and then you get access to our regulatory infrastructure with that. And last but not least, you get a proven track record. I actually had a conversation with somebody who pulled us up on this earlier today, who said your track record isn't correct because it's risk adjusted, yada yada yada. And I just went back and I said, well, technically you have both, right? You have a risk adjusted track record, which is what can be presented to investors, that comes under our regulatory compliance, of course, where you can see all of your statistics, your record over X amount of years through a regulated entity. But you also still have your broker statements. Regardless of whether you're trading on Zero or Darwinex, you're trading on live servers, okay? Because we route everything through the Darwinex exchange broker. So you can still take your broker statements or a MyFX book link and you can go and pitch that out to investors, or if you're looking to get a job in an institutional setting. Yes, I am sharing my screen. Pit Finder. Let me reboot that up and hopefully you'll be able to see it. Let me know if you can see it now. Like I say, my PC's been struggling this afternoon. Awesome, you can. Perfect. So sorry about that if you couldn't see that. Perfect. Thank you guys for confirming. But on top of having your risk-adjusted track record, which is, of course, what you see through Darwinex Zero or Darwinex, you can still take your broker statements. Like if you're applying to work in a hedge fund or you want to work at a trading desk, take your broker statement. It's coming from an FCA-regulated broker, which means there's going to be no fiddling. Okay, so your statements will still hold their weight in gold. So I didn't really get the point that this person was saying earlier when they said it doesn't matter because the track record is risk adjusted. You still get your broker statements. You can still link to MyFX book. So you get a proven track record, but not just a proven track record. It's with an FCA regulated broker, which, like I say, is worth its weight in gold. If you was to go to a trading desk and you give them some bookie broker, you know, that's got a 1 out of 10 star rating, and you know, you're going to get laughed out of there. Now, having said all of that, your MetaTrader statistics are going to be different or going to display differently to your Darwin statistics for the pure fact that your Darwin is risk adjusted. So I should mention at this point that we built a proprietary risk engine that runs 24/7 on every single trader on our platform. It's akin to having a risk manager like you would have at a professional trading desk. Again, whether it's an investment bank, a hedge fund, you know, even just a prop desk, you're always going to have a risk manager who is managing all the traders, watching over the exposure and ensuring that every trader is following their strategy, following their plan, but most of all, not doing anything reckless and stupid and putting investors' capital at risk. More so than just the normal risk that's involved with investing. Now, obviously, we have over 10,000 traders worldwide. We cannot physically employ enough risk managers to go and sit and oversee every single trader. It's not in our infrastructure, right? We're providing traders the opportunity to trade from their bedroom and still bring in institutional and professional capital. So we built the proprietary risk engine to replace the need for a risk manager. And what the risk engine does is it activates 2 times. So it activates when you open a position, and it will risk adjust that position based on A, your balance. So depending on how much capital you're trading with Darwinex, and B, your risk multiplier, which we'll get onto in a little bit throughout the presentation. But basically, if you're being tuned down, of course, your Darwin is going to be taking smaller position sizes. If you're being tuned up, i.e. you take so low exposure on your Signal account, then your Darwin is going to be having the exposure increased by the risk engine. And this happens to every single trader on the platform. The second time that the risk engine is active is when you're in a trade. So the risk engine will constantly monitor your exposure throughout the lifetime of the trade, and it measures it in D periods, which is your average trading duration, basically. And if your exposure exceeds the threshold of what's normal, the risk engine can begin to get involved in your trades. And when I say get involved, I mean it will shave off a small portion of trades if your exposure begins to increase, which is rare that that happens. It doesn't happen very often, but if you're sat in a trade, if your average trade duration is 5 minutes and then all of a sudden you're in a trade for 6 hours, of course that is quite different exposure to what you usually take. And to which a risk manager would probably pull you up on it and ask you why you're in a trade for 5 hours when your average trade duration is 5 minutes. The risk engine will simply shave a small portion of that position off to ensure that the trader hasn't A, lost their head, or B, died, right? You don't want to investor capital to be exposed into a trade just because a trade is never going to come back and close that position. So the risk engine can get involved during a position only at Darwin level. But like I say, it's not necessarily a bad thing. And I have plenty of examples of Darwins that are kind of only saved because of the risk engine. Now, our risk engine adjusts all of the traders at Darwinex and Darwinex Zero. It risk adjusts all of their trade sizes to maintain a value at risk, or VAR, or VAR, however you want to say it, of around 6.5% per month across the board. Now, VAR estimates how much money you can lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, I understand that's very wordy and it probably doesn't make much sense. So what we now have an example that I can give to you, which kind of brings this more to more sensical, if you will. So for example, if a trader has a VAR of $1,000, or in this case, 6.5%, with a 95% confidence level over 1 month, it means that there's a 95% chance that that trader won't lose more than $1,000 in a single month. Now, of course, you have to contend with things like market conditions and black swan events and the fact that trading and investing, nothing is 100%, which is why we have a confidence level of 95%. Now, this is really, really important for an investor because when an investor's allocating capital, they know their maximum downside to within a certain confidence level. So an investor can sit comfortably knowing that their maximum downside per month should be 6.5%. Now, of course, it can exceed that, and it can exceed that month on month. However, we try and mitigate that as much as we can with the risk engine and the way that it works. Now, by us doing this, it creates a level playing field, ensuring that every trader is judged based solely on their trading skill and not just the amount of risk that they're willing to take. Now, what I mean by that is you might have two traders that take exactly the same positions, let's say euro dollar longs, but trader A takes it with a small amount of size just based on personal risk preference and tolerance, whereas trader B might take 10 times the position size. They have the stop and the target in the same place, and they manage the position exactly the same. Now, trader B is going to make more money on that position just purely because of position sizing. But does it mean that trader B is a better trader than trader A when they took the same position? Of course it doesn't. It just means either two things. A, they had more capital to manage, or B, they're comfortable with taking more risk. But it doesn't necessarily mean that they're a better trader, which is important to note. Now, you might be wondering why we use 6.5% value at risk. And actually, in the early days of Darwinex, this was much higher. But 6.5% VAR is the S&P 500's risk level. We know that investors are familiar with that level of exposure and are proven to tolerate that exposure over an extended period of time, even through stagnation, even through drawdown. So what we're doing in actual fact is adjusting your strategy to a risk level that ensures it meets an investor's expectations and risk tolerance. And when I say an investor here, I don't just mean somebody who's invested £100 or £1,000 and they want to make as quick a return as possible. I'm talking about large investors who are looking to diversify a portfolio, beat the S&P, beat inflation, and maybe the next benchmark property, for example. They're looking to outperform those with less downside. The way that we do that is by risk adjusting your guys' strategy to the same risk level as the S&P, which is kind of a global benchmark for asset performance or index performance. Now, investors do have a discretionary decision to make where they can increase their risk, so they can increase their leverage which essentially if they choose 2x leverage, which goes up to 3x, 2x leverage would give them a value at risk of around 13%, and 3x would be treble through 6.5%. Mental maths isn't my strong point, so I'm not going to make myself look stupid and embarrass myself by giving you guys a wrong number. But you get the point. The investor can take that discretionary decision to increase their exposure if their risk tolerance is higher than the average professional investor. But as a standard, all Darwins come with a value at risk of there or thereabouts 6.5%. Now, this is the Darwinex Zero dashboard. I'm sure the majority of you have probably seen this before, especially if you've been trading with us for a significant amount of time. This shows your Darwin statistics. So whenever you're viewing somebody else's track record, you will always be viewing their Darwin statistics. You can see there is a tab with a Signal account and a little lock emoji. That allows you to view your own Signal account statistics. So you can see it's grayed out in this example. But if it was your own account, you can view it and it will bring up your Signal account statistics to view instead, which give you a few different metrics like your deleverage and stuff. You can choose, I believe, to make this public if you want through Darwinex, but I don't think you have the option on Darwinex Zero. I could be mistaken, so don't quote me on that. But a lot of people don't make that change. There's no need to, right? There's no need to get your Signal account statistics public. It doesn't matter to an investor and it doesn't matter to us. All we're interested in is your trades. We manage the risk. Now, under strategy analysis, you have this chart, which is your Signal account risk management chart, or your VAR chart, as I usually call it. So this is a dynamic chart that updates consistently every single day, or every single trade even. Now you can see what we've done for this example is put a big fat white line where 6.5% value at risk would be, just so that you understand in this example where the trader is in relation to the benchmark of what we risk adjust to. So you can see where the trader starts off roughly about 13% value at risk, give or take 1 or 2%. At that point, the trader's risk multiplier, which works with an inverse correlation to the value at risk chart, is probably about 0.5x. Because their value at risk is about 13%, which is double the 6.5%, we're essentially going to be cutting their trade sizes in half. Okay, so again, going back to what I said earlier, you have the balance multiplier. So if you're trading on a $100,000 account on MetaTrader, but then you're trading with $200,000 of investment capital, of course, the balance multiplier is 2x. So your position size is going to be doubled. So if you're taking a 1 lot on your Signal account, on your Darwin, it's going to be 2 lots. But then it goes through the risk multiplier. So if you're at 0.5x there, it's going to 0.5x the position size at Darwin level. So instead of 2 lots, it's back down to 1 lot. So actually, you're going to be having pretty much the same trade size and P&L from both your Signal account to your Darwin. But of course, there's a different balance, so the return percentage would be different. Now, as this chart comes down, which it will do over time, if your trading behavior changes or the amount of risk that you take on a position starts to change, then it will adjust over time. So you can see this trader starts to bring their value at risk down. Now, what's going to be happening at that point is their risk multiplier that I said works inversely correlated is going to be slightly increasing ever so slightly as this trader slowly brings this down. By the time they get to 6.5% value at risk, which you see after 3 down arrows, they then cross that barrier. At that point, their risk multiplier is going to be around 1x. Might be, 0.99, it might be 1.05, but it's going to be around about 1x. As they keep going down on their value at risk, their risk multiplier is going to go to 1.5, to 2, to 2.5, to 3x. I have a Darwin that runs at a 4.5x or 4.2x multiplier, which basically means that on my Signal account, it takes that position size and it times it by 4.2x on every single trade. Again, after the balance multiplier adjustment. But in this example, you can see it keeps going down. And whilst it's going down, the Darwin risk multiplier is going to keep increasing. And the reason it does this is so that your Darwin return will always be stable. So in this example, it looks like the trader, it doesn't look like it's a strategy specific change here. It looks like it's more a position sizing change where the trader keeps dropping their position sizing over time. Bringing it right down to pretty much 0. So they probably stop trading at that point. Well, at least for a period of time anyway. And so that, of course, their return at signal account is going to be reduced because they're now trading with smaller size. However, the Darwin has still been taking the same trades, but has been increasing the size slowly, so that the risk exposure is steady, regardless of whether they were operating at a 13% value at risk or a 0.1% value at risk at the low. The Darwin is going to be stable and is going to be recalibrating that the whole time. But what's important to note here is when the trader's underneath the white line, which is a common misconception with Darwinex, is that we just tune traders' risk down. We really don't. We also tune a lot of traders' risk up. What I mean by that is increase the position sizing. So as the traders beneath the 6.5% white line on here, their position sizing would be getting tuned up or would be getting increased. This is where you can see your risk multiplier. So this is private to you. You can only see your own. You will never see this on somebody else's dashboard, but it's the Darwin Live Trades tab. So you can see the Darwin risk on this example is 2.32x, which basically means for every one lot that the trader takes on their signal account, their Darwin's going to be taking roughly 2.32 lots. The current closure rate is in reference to what I was mentioning earlier, where the risk engine can get involved and shave off some of your positions if it needs to do that, if your exposure goes too high compared to the norm. And then under that, you can see any trades that you're in currently. So for example, here we're in a Kiwi yen sell. The MetaTrader account has 1.2 contracts or 1.2 lots active, and the Darwin has 2.79 lots active. So you can see any trade that you're in, and you can understand how much exposure you still have in the market. Again, going back to what I said earlier with trader A and trader B, who take the same trades, or even in this case, they might not take the same trades. We might have trader A who has a higher level of exposure based on the assets they trade, the frequency, the position size, and the risk engine might scale that trader down because they're operating at a higher level than 6.5% value at risk. Whereas trader B might trade a more conservative approach with a lower position size, less volatile assets, might take less trades. And therefore, our risk engine is going to be looking at those traders to find a happy medium. Might scale trader A down, might scale trader B up, and then bring them to the standard risk level of 6.5% value at risk. And this isn't to say that we're scaling everybody up or everybody down. It's a mathematical equation on how much exposure a given trader takes and how do we get them from A to B. How do we get them from 13% VAR to 6.5% VAR? How do we get them from 1% VAR to 6.5% VAR? So, you know, you might be tuned down slightly, you might be tuned down massively. All depends on how much risk you take as a trader. If I pull this back up, the only kind of red alert that we have, or the red flag, is when a trader is above 30% value at risk. Anything below 30% doesn't really concern me too much. But when a trader tips 30%, what we've seen over the past 13 years is that there's an exponential increase in risk for the trader to blow up their account. And that's what we've seen over many, many years, is that 30% is kind of the limit. Above that is an exponentially higher chance that that trader will either blow up or go through a significant drawdown. And when I say a significant drawdown, I don't just mean, 5% in 1 month. I mean like 70 or 80% drawdown. Something that's really, really difficult to come back from. Now, strategy's value at risk depends mainly on the following 4 factors. However, I split these down into 2 categories. Number 1 being strategy specific, and number 2 being position size specific. And I'll tell you why I categorize them in those 2 categories in a moment. But for the strategy specific factors, we have asset volatility. Now, this is kind of commonsensical, is the higher the volatility of the asset that you're trading generally means that your P&L is going to be higher in volatility also. Again, you can tell me I'm wrong, and I'm happy to have a debate on it, but generally the higher the volatility asset, the more risk exposure you're taking, because there's more room for the asset to move larger swings, right? So somebody who trades Bitcoin is going to see wilder swings than somebody who's trading euro dollar, just by nature of the asset. Number 2 is trade frequency. So somebody who takes more trades, again, generally might make a higher return, who knows, but they're taking more exposure in the market to generate a return. Not saying that's a good or bad thing, so please don't take this as we're penalizing somebody for taking more trades. It's not that at all. It's just saying to generate your return, you take more exposure to the market, and therefore you have an inherently higher value at risk. Same with trade duration, in the fact that It's not bad or good to hold trades for longer or shorter. However, the longer that you hold a trade, the more risk of things going wrong, the more risk of black swan events, round trips, whatever it may be, and therefore you have a higher value at risk, only slightly. And this is why I put them in this category, because these are kind of slight factors, or small factors, I say. And the reason that they're small factors is because they can be completely overruled by number 4, which is trade size, or your position sizing. Because you could trade the highest volatility asset, and you could take 500 trades a day, and you could hold them all for a year. But if you're doing that with 0.01 lots, it's going to take you a long time to blow up your account, right? And on the flip side, you could trade the lowest volatility asset. You could trade euro dollar, for example, something low volatility like euro dollar. You might take one trade a year, and you might hold that trade for 5 minutes. So you barely have zero. You basically have zero market exposure year on year. But if you do that with 1,000 lots, you're probably going to blow up your account pretty quick. And therefore, it doesn't matter what the asset volatility, trade frequency, or trade duration is, because you're just taking too much size. So that's why I categorize them separately, because I think trade size is the one that you can play around with a little bit more. You can change that without actually having to change your market approach or your strategy. Whereas if you're going to look at reducing the volatility of the assets or the frequency, duration, you have to start playing around with your strategy. And that's absolutely what we don't want people to do when they come to Darwinex Zero. We want you to come with your strategy and prove it's profitable in its current format. I don't want you to start changing things just to fit the risk engine. Position sizing, okay. If you're risking too high, bring your risk down. If you're risking too low, of course, scale it up a little bit. But don't change your strategy to suit the risk engine. So before we finish up, here's a couple of frequently asked questions that I usually get after running these sessions. Number 1 is, when will my Darwin be listed? So after the calibration phase, your Darwin gets listed on the following Monday. So let's say it's a Friday and you finish your 15 days and your trading decisions, your Darwin will be created on the Monday after the weekend. The reason we do that is because we create all Darwins whilst the market is closed over the weekend, ready to be listed on a Monday. Number 2, shall I stop trading whilst it's being listed? Absolutely no way, because even whilst it's being listed, we still count all of those trades. I always say never stop trading your account, just keep trading it. Even if you're, if you've got an allocation locked in for the month or performance fees, just keep trading your account. Have confidence in yourself. This is a long game, or a long-term game, sorry. And you need to have that long-term vision with it. Don't stop trading just to lock something in, right? It doesn't make sense. Number 3, shall I increase or reduce my risk? Again, going back to what I was saying, unless your value at risk is above 30%, I wouldn't be too concerned. And don't get caught on the hamster wheel trying to perfect your value at risk or your risk multiplier, when really the only important thing is how well do you trade, or the quality of your trades. That's all I want you guys to focus on, is how can I take the best possible trades that I can. Number 4, how to increase my risk multiplier. I've already been through this. Just decrease your value at risk. Do it gradually over time. Slowly lower your position sizing, and you'll see your risk multiplier will start to increase. However, it's, again, you're getting stuck on the hamster wheel, because your Darwin is always going to come out to the same result anyway, because it's risk adjusted. Number 5, I've already answered this. Is it bad to have a high or low multiplier? It's absolutely not bad at all, unless your value at risk is above 30%. Then just be cautious that you're kind of in a category of traders who historically have shown the ability to blow up or go through an extended period of drawdown. And so I would just say be cautious, but it's not necessarily a bad thing. And finally, I just want to say thank you all for joining. If you've got any questions, because you guys have been quiet throughout this session, please drop them in now. I'm going to check Instagram because the comments don't come through. But if you guys on YouTube, X, or Discord have got any questions, please feel free to pop them in the chat now, and I'll go over them before we finish. Equity Maverick asked, what about drawdown? Okay. That's quite a broad question, because I don't know at what point you asked that question. But drawdown doesn't come into the factor when we're talking about your exposure. Drawdown is a backwards looking metric. So it's looking at what happened in the past, but it's not a good, or it's not an accurate measure of what can happen in the future. right? What's more important is to use a forward-looking metric like value at risk to understand on a day-by-day basis how much risk the trader takes to generate their return, not how bad things have got in the past. Because the systems that there was a system called Waka Waka, if you've ever heard of it, which was an expert advisor, a martingale expert advisor. The max drawdown was 12%, ran it for 5 years. After that 5-year period, it went on a 70% drawdown. Now, in that case, you look at the max drawdown, you say, well, how was we supposed to know that that was going to happen at some point? But if you look to their value at risk, you would see the mismatch in their exposure. Reed said, can the risk engine close my trades as a swing trader? It won't ever close 100% of your trades, right? So whenever you're in a trade, your Darwin will always be in a trade. It can close some of your exposure. However, because you are a swing trader, I would presume that your trades are held for a longer period of time than, you know, a scalper. And therefore, the way that the risk engine does it is quite dynamic. It's not going to penalize you as if you was a scalper, right? So it's not going to go, oh, it's been 15 minutes, we're going to close some of his exposure. It's going to look at your average trade duration, measure it in D periods, and then say, okay, well, Reed usually takes X amount of exposure within this period of time. Let's wait until the exposure exceeds that. Okay, let's wait until his deleverage exceeds the average exposure that they take. So it works the same as it would for a scalper, being that you're a swing trader, but I wouldn't worry about it. If you want to take a look at whether you've been risk adjusted in the past, you can always come to Darwinex.com, BYXB. Let's take a look. So you can view your Darwin statistics if you go to Darwinex.com. As well as Darwinex Zero, but this metric is specifically available on Darwinex Classic. Just make sure you can see my screen. Yep, you can. You have to sign into an account. So if you haven't got an account with Darwinex.com, you should be able to log in with your Darwinex Zero login or your Darwinex Zero username and password. Then put /Darwin and then / your 4-ticker Darwin name and a hashtag at the end. Don't know why the hashtag works, but it makes it available to view zero Darwins. Once you're on here, come over to this investable attribute over here, which is risk adjustment. This is one of my Darwins, so you can see it's a 10 out of 10 risk adjustment, which basically means the risk engine doesn't really get involved in my trades too much. Now on here, you have three colored dots. You have green dots where the risk engine didn't get involved in your trades at all. You have amber dots where it does get involved, and you have red, which is where it closes a lot of the position sizing. But you can see, I think I've had 560 trades, maybe 570, and there's only a few where the risk engine has closed the exposure. Okay, so I wouldn't be too concerned about it, but if you want to see your own version of this statistic, like I say, just come to Darwinex.com, and then it's the risk adjustment statistic, and you should also be knowledge. You can go to the Darwinex knowledge base, so help.darwinex.com, and then you can search risk adjustment. And then take a look at the attribute breakdown. And it'll explain exactly what that investable attribute, exactly what this measures and how it measures it. Okay. So it's worth taking a look at this. So you got green bubbles, red bubbles, and orange bubbles. It actually tells you on here, so it's worthwhile taking a look at this. Tells you about your deleverage and about the exposure limits before the risk engine gets involved. So if you want to have a look at a little bit more detail on that read, take a look on there, and it'll explain exactly how that works. FX Pit Finder said, "How does the drawdown get better?" I mean, drawdown can't really get better because once drawdown's there, it's kind of there forever. You just got to work out of it and hopefully never not go back into bad drawdown again. But I don't really know. I don't really know how to answer that question. Drawdown isn't a factor that affects your value at risk, though, if that helps. Thank you guys for your questions, by the way. I appreciate it. I asked because of the gold state saying one must not exceed 8%. No, that's not true. So gold, you don't have to not exceed 8%. The That's a miscommunication wherever you've heard that from. Basically, to hit gold, you have to hit a few performance objectives. First being that your track record is at least 8 months old. Second being that you have at least 20% return. And third being, which is where this miscommunication is, the third being is that you need a return to drawdown ratio of at least 2.5x minimum. Now, what that would mean is if you have the 20% return, that would mean no more than an 8% drawdown. If you have a 25% return, it would mean no more than 10% drawdown, and so on and so forth. Basically, your drawdown can't be no. Your return has to be 2.5 times your max drawdown or more. Okay, so let's say your max drawdown was 20%. Your return would have to be 50% plus. Yeah, 50% plus. But the 8% figure is if you was having a return of 20%, which is one of the other metrics to hit gold. Okay, perfect. Well, guys, we'll call it an end of the session now. Thank you very much for your questions, and thank you very much for joining the session. I don't like being a lonely person sat here talking to my screens, so it's always great to have you guys in the sessions and to interact with all of you. So I appreciate it massively. Guys, have a fantastic rest of your week. Have a great weekend. Appreciate the kind words, FX Pit Finder. It's great to have you back in these sessions regularly too. So thank you very much for that. But have a fantastic rest of your week, guys. Enjoy your weekends, and then let's crush it again next week. And we'll be back on Monday for a performance coaching session with Sanjeev. So that's on Monday. Yeah, we do them bi-weekly, and I think it's next week. I'll have to check my calendar. So we'll see you on Monday, and then I'm back to do a welcome session on Tuesday at 5 p.m. UK time. So I'll speak to you all next week, guys. Have a fantastic weekend, and I will catch you in the next one. Peace out.